All participants, please stand by. Your conference is ready to begin. Thank you all for joining us this morning. Welcome to the Pretium Resources Fourth Quarter 2020 conference call. As a reminder, all participants are in listen-only mode and the conference is being recorded. After the presentation, there will be an opportunity to ask questions. The conference call today is being webcast live and available along with the presentation slides on Pretium's website at pretivm.com. I will now turn the call over to Mr. Jacques Perron, Pretium's President and CEO.
Thank you. Good morning, everyone. Welcome to our fourth quarter and 2020 year-end operating and financial results conference call. 2020 has been an unprecedented year with exceptional challenges. I want to thank our team for their continued hard work and dedication. However, no year is considered a success unless it is accomplished safely. And in 2020, a fatality provided a tragic reminder of the importance of keeping safety at the forefront of everything we do. On today's call, I will briefly highlight some of our key achievements from 2020. I will then turn the call over to Patrick Godin, our Chief Operating Officer, to provide some insight into our production and operating results. Following that, Matthew Quinlan, our Chief Financial Officer, will review financial highlights of 2020. Finally, I will provide an overview of our near-mine exploration results and the recently announced underground exploration drilling results before closing off with a look ahead. At the end of the presentation, we will open the call to your questions. Before we begin, note that our statements contain forward-looking information and future-oriented financial information based on certain assumptions and subject to risk factors. I refer you to the cautionary language included in our news release yesterday, as well as the management discussion and analysis for the same periods. These are available on our website and have been filed on SEDAR. Please note, all dollar amounts mentioned on this call are in US dollars, unless otherwise noted. Despite the challenges faced in 2020, we achieved our annual production guidance for the first time in the company's history. Nearly 348,000 ounces of gold were produced at Brucejack, and we generated a record free cash flow of $369 million. This allowed us to significantly reduce our debt by $227 million. After debt repayment, we ended the quarter with a cash balance of nearly $175 million. Other objectives achieved in 2020 include accelerated underground development, ramped up production to an average processing rate of 3,800 tons per day, increased drilled off stope inventory, completed 147,000 meters of in-resource definition diamond and RC drilling, as well as 28,000 meters of resource expansion drilling, and announced the discovery at the Hanging Glacier Zone, just 4 kilometers from the Brucejack mine. We have refocused our efforts in terms of health and safety, and we are implementing changes to improve our safety culture. We will do everything we can to avoid the repeat of the tragic event that occurred at the beginning of the third quarter. The well-being and safety of our workforce remains our most important core value. On February 10, 2021, BC Northern Health declared a COVID-19 outbreak at the Brucejack mine. To protect the health and safety of our workforce and local communities, we implemented enhanced outbreak protocols. This included restrictions on travel to and from the Brucejack mine camp, while site-wide testing was conducted, and an assessment by BC Northern Health could be completed. It was determined that the majority of the positive cases were restricted to a limited cluster, and on February 17, travel restrictions were lifted. Additional protocols and procedures developed in collaboration with local Indigenous partners and BC Northern Health have been established, which includes testing of all employees and contractors. Throughout the outbreak, mine and mill production continued, albeit at a reduced pace for a few weeks. The company is assessing the potential impact on operations and will continue to closely monitor the situation and provide updates as appropriate. This is a reminder that COVID-19 remains a risk and could have a significant impact over a short period of time. I will now turn the call over to Patrick to review our operational highlights for the fourth quarter and full year 2020.
Thanks, Jacques. Turning to operation on slide 7, in the fourth quarter, we processed approximately 310,000 dry tons of ore through the mill, equivalent to 3,366 tons per day. And for the full year, we processed approximately 1.3 million tons of ore, which averaged out to 3,572 tons per day. The mill operated below the permitted level of 3,800 tons per day due to scheduled and unscheduled maintenance and our focus on lateral development and stope availability. By the end of the quarter, we successfully ramped up to an average processing rate slightly above 3,800 tons per day in the month of December. Production costs were $217 per ton milled in the fourth quarter and were $195 per ton milled in the full year of 2020. Production costs increased due to the additional lateral development and definition drilling and costs associated with COVID-19 safety protocols, mainly related to employee salaries and travel costs. These protocols have increased costs by $5 per ton milled in the quarter and $6 per ton milled in the full year of 2020. In the fourth quarter, we produced just over 88,000 ounces of gold. The mill feed averaged 8.9 grams per ton, and the recovery rate was 97.4%. Over the full year, we produced nearly 348,000 ounces of gold at an average grade of 8.5 grams per ton at a recovery rate of 97%. When you look at the quarterly gold production for the year, you see that we have maintained our production level within plus or minus 5% of the midpoint of our guidance range. It is broadly understood that Brucejack is a high-grade variable deposit. We will continue to see fluctuation in production on a quarterly basis, but hope to smooth that out over time. Going forward, our objective is to optimize production, reduce the quarter-to-quarter fluctuations, and at the same time look for opportunities to increase our production. The 2020 mineral reserve reconciliation was completed by evaluating the 2020 mineral reserves against the 2020 milled actuals. In 2020, ore was mined from 69 stopes over 11 levels, spanning an horizontal distance of approximately 540 meters east to west and 310 meters north to south. The 2020 milled actual contains approximately 4% more ton than the 2020 mineral reserve, primarily due to mining all of reserve material determined to be economic by the grade control program, as well as greater than planned stope dilution. Compared to 2019 mineral reserve reconciliation, the 2020 mineral reserve gold grade reconciliation improved from 72% in 2019 to 94% in 2020. This improvement can be attributed to the inclusion of the mine call factor and the updated 2020 mineral reserve model. We expect to release an updated mineral resource and mineral reserve estimate and revised life of mine plan in the first half of 2022. The current January 2020 mineral resource model includes portion of the January 2019 and December 2013 mineral resource models that have required the application of a mine call factor in the mineral reserves. The 2022 mineral resource and mineral reserve will update the entire area of the Valley of the King zone with the result of the extensive 2021 drill program, previous drilling, and knowledge gained from more than 3 years of mining. In order to improve our knowledge of the ore body and establish a mine plan to reduce the production variability, we have two main priorities. Our first priority is to increase access underground. Lateral development will continue to advance at a rate of over 1,000 meters per month. The increased development rate will improve access to new areas and increase our drill-off inventory of stopes. Our target is to have about 400,000 tons of drill stope ready to be blasted, equivalent to a full quarter of production by the end of the third quarter of 2021. This should provide more flexibility to improve blending from multiple areas and support more consistent production. Our second priority is to increase our understanding of the ore body at Brucejack. With any variable resource, it is important to have as much data as possible to properly estimate the grade and design the mining approach. To improve the local modeling, we have significantly increased the amount of definition drilling. As you can see on this slide, our development rate has been increasing. In Q1 of 2020, we were affected by COVID-related restrictions. We had to reduce the level of activities at site, but we recovered in the second quarter. In the fourth quarter, we continued that trend of increased production. Turning now to slide 12, we have a section view of the underground development looking north. Until recently, mining has been limited to only 2 mining horizons at Brucejack. A mining horizon consists of 4 mining levels, each about 30 meters in height. Earlier this year, we opened up mining on the lower horizon of the 1020 level. We now have 3 mining horizons to operate from. In 2020, we began developing access into the fault zone, which is just west of the Brucejack fault on the 1200 and 1320 levels. We are starting to open and prepare this area for mining later this year. In the second half of this year, we will increase access for mining from 3 to 5 areas, which will provide significantly more flexibility in terms of production compared to previous years. Infill drilling to improve reserve definition ahead of mining was put on hold at the onset of COVID at the end of the first quarter to limit personnel at Brucejack. By the end of the second quarter, diamond drilling activities had resumed and continued through the third and fourth quarter with 5 diamond drills on site. Here on slide 13, we have a section view of the underground development looking east. You can see the drill target areas for the year highlighted in yellow. In 2020, we completed approximately 147 meters of infill diamond and reverse circulation drilling. Now we'll turn the call over to Matthew for an overview of our financial performance.
Thanks, Patrick. We continued our track record of positive cash flows again in 2020, as we have every year since achieving commercial production in 2017. For the year, we realized a gold price of $1,799 per ounce, an increase of 28% over 2019. Revenue increased by a similar 27% due to consistent production across periods. In 2020, we sold approximately 348,000 ounces of gold. Net loss of 21 cents per share for the year was impacted by the sale of Snowfield in the amount of 80 cents per share. Adjusted earnings per share for 2020 increased by 72% to 95 cents per share and were 28 cents per share in the fourth quarter of 2020. Adjusted earnings per share exclude the effect of the loss on sale of Snowfield, as well as deferred income tax expenses, both of which are non-cash items. You may note from our financial statements that the net loss for the year was due to a large deferred tax expense in excess of our earnings before taxes. The sale of Snowfield gave rise to a non-cash deferred tax expense, even though a loss on sale was recognized, as Snowfield did not have any tax basis. Therefore, no reduction in the loss could be accrued. In addition, the proceeds received from the sale reduced our tax pools, giving rise to a further deferred tax expense. I would like to stress that no cash taxes will be payable on the proceeds from the sale of Snowfield, and as we have stated before, we are not in a cash taxable position due to capital expenditure pools and tax loss pools arising from the development of Brucejack. We don't anticipate paying cash taxes for federal and provincial income taxes for 3 to 4 years at current gold prices, and once we are in a tax payable position, we anticipate paying taxes at a combined rate of 36.5% of mine operating earnings. Turning to slide 16, the year-over-year increase in revenues of $133 million to $617 million helped drive cash flow from operations to $317 million for the year, an increase of 41%. Operating cash flows reflect COVID-19 costs as well as higher year-over-year production costs, and a component of all-in sustaining cash costs. Total capital expenditures of $49 million in 2020 include approximately $27 million of sustaining capital expenditures, $12 million of expansion capital, and $10 million of additions to exploration and evaluation assets in the year. Free cash flow reached a record of $369.2 million for the year, double the level of 2019. In terms of quarterly results, operating cash flow and free cash flow in the fourth quarter of 2020 were $89 million and $170 million respectively. The fourth quarter 2020 free cash flow, of course, includes the $100 million received from the sale of Snowfield. Consistent with our stated objectives, we used our strong cash flows to significantly reduce debt and made net debt repayments of $210 million in the year. We ended the year with approximately $270 million of debt, comprising of bank debt of approximately $171 million and convertible notes of $100 million. Cash on hand and available liquidity were approximately $175 million and $335 million respectively at year end. Turning to slide 17, AISC in 2020 of $981 per ounce was within our guidance range for the year. AISC increased from $888 in 2019, primarily due to increased levels of lateral development and drilling included in production costs, as well as $24 per ounce of COVID-19 related costs and $20 per ounce related to the departure of former officers. In summary, we successfully achieved our 2020 operating and financial guidance and generated record free cash flow. Before I pass the call back to Jacques, I would like to note one accounting policy change we noted in our financial statements in MD&A that will take effect on January 1st, 2021. Moving forward, we will expense certain exploration and valuation expenses rather than capitalize them on the balance sheet. This will only apply to expenditures for regional exploration, such as Hanging Glacier, and will not affect the accounting treatment of exploration and drilling within the Brucejack mine. As I just mentioned, in 2020, we incurred approximately $10 million of such expenses. This change in policy reflects the maturation of our business into an established mid-tier gold producer. It's important to note that the accounting policy change will not affect the calculation of free cash flow, AISC, or total cash costs. However, as accounting policy changes such as these are applied retroactively to the inception of the company back in 2010, there will be a number of changes to our historical financial statements when we release them in the first quarter of this year. With that, back to you, Jacques.
Hey, thank you, Matt. Stepping further out from the Brucejack mine, we hold over 1,200 square kilometers of mineral claims in the Golden Triangle in BC. The 2020 regional exploration program on the company's Bowser claims included drilling at the Hanging Glacier zone and other zones. The highlight from the program was the discovery of epithermal-style gold mineralization in the Hanging Glacier zone, located just 4 kilometers northwest from the Brucejack mine. The new zone of gold mineralization demonstrates the district-scale potential at Brucejack. We continue to believe the best value for our shareholders is to invest a portion of our cash flow in exploration of our existing claims, and in particular near the Brucejack deposit. In 2021, we expect gold production at the Brucejack mine to be in the range of 325 to 365,000 ounces. We forecast the processing rate to average 3,800 tons per day, with an annual gold grade ranging from 7.5 to 8.5 gram per ton at a targeted gold recovery of 97%. We expect all-in sustaining costs for 2021 to range from $1,060 to $1,190 per ounce of gold sold. AISC estimates in 2021 reflect the investments in an accelerated rate of underground development, comprehensive drill programs, and improvement-oriented capital expenditures. We forecast sustaining capital expenditures, a component of AISC, to be between $50 to $55 million. This includes the capitalized portion of underground development and drill programs, as well as improvement-oriented expenses, such as starting to replace the haul trucks fleet, to reduce costs to ventilation and maintenance, and increase productivity. We expect free cash flow for 2021 in the range of $120 to $170 million at a gold price of $1,700 per ounce. The 2021 free cash flow forecast includes expansion-oriented capital expenditures, which total approximately $55 to $65 million. This includes construction of permanent camps and projects to support growth and to improve efficiency of operations. The free cash flow forecast also includes expenditures related to the 2021 near mine exploration program. The 2021 Brucejack definition and expansion drill program is anticipated to total approximately 195,000 meters of drilling, comprised of definition and sustaining and resource expansion drilling. Underground resource expansion and exploration drilling will target near mine zones with the potential to extend mineralization underground. Initially, 6 drills are planned to be deployed underground, with an additional 2 surface drills to be added during the summer. In 2020, we completed about 28,000 meters of resource expansion drilling outside the resource shell to the north of the Valley of the Kings zone. This is the first time resource expansion drilling has been conducted at Brucejack since production started. Yesterday, we announced the results from the first phase of 2020 resource expansion drill program, which included high-grade gold intercept as far as 300 meters from the current resource shell and as high as 2,590 grams per ton over 1 meter. The North Block zone is an exciting potential extension of the Valley of the Kings deposit at Brucejack. We have already committed to significantly increase our resource expansion and exploration efforts in 2021, and the results from this first phase support our decision to make that investment. Looking ahead to 2021, we will continue to emphasize safety with a focus on what we can do to improve the safety culture. We will also maintain our strict COVID safety protocols to minimize the potential for another outbreak at site. Based on our production and gold price estimates, we expect to generate a significant amount of cash this year. We look forward to continuing to announce drill results. The remainder of the 2020 resource expansion drill results are expected in the second quarter. We will continue to provide results from the 2021 resource expansion drilling throughout the year as they become available. Looking further ahead, we will continue to advance our exploration efforts near mine, where we intend to build on our resources. Thank you, and that concludes the formal part of the presentation. I will now turn the call over to the operator who will open the lines for your questions. Operator?
Thank you. We will now begin the question and answer session. To join the question queue, you may press star, then 1 on your telephone keypad. You will hear a tone acknowledging your request. If you are using a speakerphone, please pick up your handset before pressing any keys. To withdraw your question, please press star, then 2. We will pause for a moment as callers join the queue. Our first question comes from Heiko Ihle of H.C. Wainwright. Please go ahead.
Hey, thanks for taking my questions. It's nice to see everything you've accomplished throughout 2020, especially noting here your balance sheet. It also highlights that the guidance uses gold price of $1,700 an ounce, so it's actually 2% below what we're at right now. Can you walk us a little bit through the travel restrictions at Brucejack, or like the issues that you've had, and how your labor force is currently reacting? Are there any lasting issues? Have there been any longer-term changes? What are you seeing? What are you hearing on the ground, please?
Good morning, Heiko. Thank you for your question. I'll give you a bit of color, and Pat will can add to what I'll provide. But we were fortunate in 2020 to be able to operate the mine without any COVID cases at site and positive COVID cases at site. Unfortunately, we were worried that after the holiday period that we might get some impact from people traveling and coming back to site and bringing the virus to site, and that happened to us. So we started to manage cases, monitor the situation, and the number of cases increased quite rapidly because it was contained into a cluster of employees that were working together and not necessarily following all the proper rules and protocol. And as you know, we've been repeating worldwide for a year now that it's important to wash your hands and wear your mask and be diligent. And we found out that through all the tracing we've done that a small number of our employees were not, or contractors were not following the rules. And on that note, I want to say that the majority of our employees, the vast majority of our employees are following the rules and are doing a great job, but it only takes a few to start to spread the virus, and we started to isolate people to a point where BC Northern Health decided that we had to control the situation by locking down the site, so preventing people from traveling in and out, and testing everybody to understand the extent of the various people that were infected. It took about 2 days to test everybody, and we got the results fairly quickly. Definitely during that period, the employees were concerned and were worried, but I can tell you when we lifted the travel restriction on the 17th, morale shot up by thousands of %, because as you can imagine, being stuck at site and not knowing when you're going to be able to leave, and being afraid that the virus is around you, and it was a very uncomfortable situation for a lot of people, but it's much better right now. And with that, we have worked closely with our indigenous partner to implement new protocols and new rules. And I'll let Patrick explain how we're managing the situation now and what's the process to mitigate the risk of having another outbreak.
Yeah, so in addition to respect the rules, because it's where is basically the main issue, is when we're not respecting the rules. We are now testing all the employees when they're coming in 5 days after their arrival and before to let them leave the site. So basically, it helps us to have a better control of what we are doing. We are also looking to actually improve the testing protocol with rapid testing. We are in discussion with the authorities with that. And also, we had some additional protocols because, as you know, at Brucejack, we have 3 camps: one camp at the entry, one camp at the beginning of the glacier, and the main camp at the operation. So we have additional protocols to control the access with the suppliers and contractors. And also, in addition to that, we create what we call bubbles, is mainly now for our native partners who are living in northern territories. When they are tested at site, immediately after that, they are leaving the site together in a specific vehicle, and they are going back to their community. So we're just making sure that they are not exposed on the way to a person who is potentially infected. So we improved a lot in this manner. I think the employees are pretty satisfied by this, we will apply all these protocols up to the moment that probably the authorities will advise that we don't have to.
Okay. A very comprehensive and good answer. I appreciate that. Thank you. The other one, I think I'm just trying to clarify something with your corporate administrative costs. 2 quick things there. They went up 13.6% or $2.5 million to $21.2 million. Looks like this is pretty much an increase in salaries and benefits due to a variety of termination expenses, but it was also offset by some share-based comp. Nonetheless, you're still looking at 18 to 22 million for 2021, so the midpoint of that's 20 million. First of all, is the cash versus non-cash, is that an offsetting thing, or is that an accounting thing, or what am I missing?
I don't think you're missing anything. You're bang on. It's Matthew Quinlan here. In 2020, you're right, there were certain termination expenses and then pursuant to those employment contracts. Countervailing that was when those officers left, there was a certain forfeiture of their RSUs and deferred comp, so there was a much lower non-cash component. Going forward, we've obviously have guidance next for this year in 2021 of $18 to $22 million of G&A. There'll be a higher component of RSUs and deferred comp because that is though there's no forfeitures, but commensurately there's a lower cash expense. Does that help answer the question?
Okay. Yes, it does, and it actually answers my next question as well. And then I just have just to follow up on that. Why do you still expect 20 million? Because presumably that termination stuff was a one-time thing.
You're right, but the forfeitures were actually quite large. And on page 27 of our MD&A, there's some further details as to the quantum. So just looking for that page right now, the several $1 million was the effect on the RSU expense.
Got it. Okay, perfect. Thank you very much. I'll get back with you. I appreciate your answers.
Thank you.
Our next question comes from Anita Soni of CIBC World Markets. Please go ahead.
Hi, good morning, everyone. My first question is with regard to the reserve reconciliation that you guys provided versus what was milled in 2020. Can you give us a breakout of what was attributable to mining outside of the reserve envelope and what was attributable to stope dilution, excess stope dilution? And then secondly on that would be the amount of excess stope dilution. So what are you seeing in terms of dilution and what are your targets?
Okay, in terms of dilution, in the reserve, we plan 94% of mining recovery and 12% of dilution. For 2020, in terms of mining recovery, we are 88.3, and in terms of dilution, we are 18.2. So basically, it's the increase in dilution is explaining a part of it.
Okay. Yeah, and then that's explaining. I mean, so would you say it's more stope dilution than mining outside of the reserve envelope that was, caused a 6% off on the grade?
I will say 50-50.
50-50. Okay. And then in terms of go forward, do you expect that similar types of dilution? I mean, going forward in 2021, is that what you guys are factoring in when you took down? I mean, the prior life of mine plan had 8.6 for this year, and then when you guys put out guidance, and thank you for this call because it's the first opportunity we have to talk to you about the guidance here. The grade went down from 8.6 to 7.5 to 8.5. So I'm just trying to get an understanding of the implications of that beyond 2021.
So I can say to you that for the dilution, we are still forecasting in our reserve 12, because I don't want to lower the bar in terms of quality. So and we are working really hard actually to improve our dilution. The trend is in that way, but we're still planning 12% of dilution going forward. Okay.
So then why was there a change in the reserve grade from what the life of mine plan had sort of given us as what we should be looking for in 2021?
It's mainly sequencing, Anita. It's when I've repeated this a few times. There's a difference between guidance and reserve. The reserve is one thing, but the guidance we always we have a variable ore body, so we guide 7.5 to 8.5. Last year was 7.5 to 8.6. Why not 8.6? We could have used 8.6 this year, but we said 7.5 to 8.5 because we know we're going to have variability, and I've learned in this business over the years that it's better to underpromise and overdeliver. So I wouldn't link the guidance to the reserve. Those are two different things in my mind.
Okay. We do have to have something though to try to put in our models, and usually the 43-101 is what you look to. But I'll leave that point. And second question, final one, then I'll leave it for some other people to ask questions. In terms of the costs, that Q4, the costs were up quarter over quarter, and is that the kind of unit cost range you're looking for in 2021? And again, are those the types of unit costs in like the 210, 215 level that you expect to see out in 2022 and beyond, or is there some kind of improvements that you'll see versus 2021?
Okay, so for Q4, we have the main one is that we process less tons, so it impact the unit cost per ton for sure. No matter if the grade was higher than expected, and also we have the seasonal effect on a quarterly basis from a quarter to the other one. In winter, our operating costs are higher than summer. On the year, we average 195. So basically, it's we are more or less trending next year between 215 and 195.
I think if you do the math, Anita, and you look at the costs we had in the fourth quarter, you will remember that we had a 10-day maintenance shutdown to replace the feeder on the crusher underground. So if we had operated the full quarter at 3,800 tons per day, if you take, you would have had a slightly increased variable cost for reagents and balls and whatnot in the mill, but at the end of the day, the cost would have been closer to 195 to 200. So if you look at the average for between the quarter and the year, that's probably where we're going to sit for 2021 at this point. Now that being said, it's going to definitely depend on COVID. Like in the first quarter, we were impacted for a few weeks. We had to reduce throughput because we had people in isolation, and we were running out of operators or people to feed the mill. So we had to reduce the throughput. That's going to have an impact on our unit costs if we don't process the 3,800 tons per day. But with the mill that we have the ability to catch up. So Q1, we might be a little lower in Q1, and we'll be better in the other quarters. And also in Q1, we have seasonality. Like I think last time I checked, we were up now to about 14 meters of snowfall at site. Last year we got 17 meters, so we have about 90 temporary employees shoveling snow in the winter. So that's an additional cost that we don't have in the summer months. So seasonality is an impact, and also tonnage. But like I said, we had a slight impact in the last couple of weeks because of COVID. If we get back and we're not impacted by COVID, anywhere between if you take the average between 195 and 217, I think you're going to be in the ballpark.
Okay, well, luckily back end loading with this gold price environment in Q1 won't be such a bad thing. So anyway, I'll leave it at that.
Okay, thank you.
Our next question comes from Joseph Reagor of Roth Capital Partners. Please go ahead.
Hi, guys. Thanks for taking my questions.
Good morning.
Morning. So, kind of following on a little bit of what Anita was asking, maybe asked in a different way. Looking at this year's guidance, the 7.5 to 8.5 grams per ton, is another way of looking at that you would expect something between an 85% and 100% reconciliation? Looking back at, you said, 94 for last year. Is that kind of what the guidance is based on, or is it, 80 to 95? Like, how would we think about that in a reconciliation kind of way?
As Jacques said, the 7.5 to 8.5 guidance is not based. It's based more on sequencing. It's based more on the fact that if a stope is ready to be mined because the other one was backfill or not. So it's more a question of sequencing. I think if you look up to me, the reconciliation at 94% is for this year is excellent. It's in the range of the reserve. If you can be in the range of 5% of accuracy for reserve, it's excellent. And we have a ore body that is having a nugget effect, so the variability is really significant. So in this regard, we're not expecting. Actually, I think we are in the, if I consider the sweet spot in terms of reconciliation in terms of ton, in terms of grade. And I think the trend is to maintain more or less, and we expect that next year we're going to be better. But I think we are where we are. When it's not based, the guidance are not based at all on the reconciliation factor.
Oh, okay. So that you're not like discounting a flat percentage either. It's just that's what's in the mine plan, depending on which stopes you open.
Yep.
Yeah.
Okay.
We said to you that we mined 69 stope this year, and it's a lot of stope for the lower tonnage of 3,800 tons per day. So it can happen, and next year we will, at year end or beginning of the year, we will shift some stope from one quarter to another one, and it will affect. So it's more a sequencing factor than something else.
Okay. And then on the debt front, any goals for this year for further debt reduction, specifically, or any thoughts about refinancing what's left, while rates are low?
Well, Matt can give you some more color, but as we mentioned last year, one of our priorities is to reduce the debt. But we want to work in the first half of this year to come up with a good plan, which is not finalized right now, but we want to build our plan, and Matt can give you a little bit of color on that.
Thanks, Joe. Yeah, we have a very strong bank group, very supportive bank group. We have a largely undrawn revolver, as you'll see in our financial statements, that matures in 2022. So we are going to be looking to refinance the revolver, and we also have the convert due in March that we need to address as part of that strategy. But we're certainly not being complacent about refinancing. We have an action plan, and we'll update the market when that's done.
All right. Thanks. I'll turn it over.
Thank you.
Our next question comes from Ovais Habib of Scotiabank. Please go ahead.
Hi, Jacques and Pretium team, and thanks for taking my questions.
Good morning, Ovais.
Good morning. Just a couple of questions have been answered, so just a follow-up question on on Aiko's question on COVID impacts. Now, it was great to hear that you guys have reiterated your 2021 guidance despite the COVID challenges that you guys faced in February. Now, are you noticing any impacts to your drill campaign or underground development kind of going into the next couple of quarters based on what you saw in February?
Not really, because when we pre-authorized, as Jacques explained, we were short of manpower because few were in isolation and some others were not available to reach the site. We prioritize in our strategy the production drilling and the development, mainly because if you are in an underground mine and you're losing opportunities in development and production drilling, you cannot catch up. So basically, actually, we maintain the accelerator and the pace for the development and the production drilling, and we slow down the mill. As Jacques explained, this mill is really efficient. We can process slightly more than 4,000 tons per day easily. So we will be in the possibility to catch up going forward. So basically, we position ourselves, we mitigate our risk to keep the development and keep the production and the production drilling on the forefront. And we did not slow down more than expected the exploration drilling too, because it's critical and crucial for us. But we know that we can process more going forward and we can catch up in a timely manner.
Okay, that's good to hear. And just my second question is on, I believe you completed about 72,000 meters of infill drilling in 2020. Can you provide some color on if this campaign was kind of in line with your expectations, and has that campaign kind of provided any improved visibility?
Yeah, well, we did a lot of drilling in the second half of the year. And so far the results match our expectations. What I can tell you is one of the challenges that we have right now is when we drill and we take a sample, because our lab at site is basically too small to handle all the samples we generate, we have to send samples outside to outside lab. And right now, it takes anywhere between 10 and 13 weeks for us to get the assays back, which is a big challenge when you have to make decisions on where you're going to develop and where you're going to mine. And so that's one of the reasons this year we're investing money in building a new lab, and a proper lab that will be able to handle all our samples and give us, results within 1 to 2 weeks instead of 10 to 13 weeks. So we did quite a bit of drilling in 2020, but we only got results for maybe, let's say, like half of what we drilled. We're still waiting for the other half. So the labs in Canada right now, like in Vancouver, there's labs processing samples from Quebec and Ontario, and some of our samples go down as far as Peru to get analyzed. So it's a real challenge. Good to see the gold price that high, but everybody's drilling right now. So it puts a lot of pressures on labs. So we expect to have our new labs operational in the third quarter, at the beginning of the third quarter. So when we get there, we'll have a much better turnaround and be able to digest the information faster. And that's one of the reasons that we decided not to update our resource and reserve this year, because we drilled a lot last year, but we didn't really have the results from the drilling. So we'll be in a much better place at the end of this year, and that's why we were planning to update our mineral resource and mineral reserves in 2022.
Got it. Okay. Thanks for that, Jacques, and that's it for me.
Thank you, Ovais. Have a good day.
You too.
Our next question comes from Don DeMarco of National Bank Financial. Please go ahead.
Oh, thanks so much for taking my call. Hi, Jacques and team. Some great Phase 1 expansion drilling results released yesterday morning. You mentioned those from the North Block, impressive grades over 2,500 grams per ton. How accessible are these high-grade zones? We know that they're within 300 meters of the pit shell.
Yeah, Don, if you look at the sections and the little drawings that are available with the release that we issued yesterday, like it's right there. It's right next to the development. What the North Block is drilling outside of the resource shell, but basically what we're drilling there are extensions of the domains of the VOK. And we're starting to see new domains appearing, and it's the same style of mineralization. So the results we're getting so far are very much in line in what we get at the VOK. So it's early days. It's only a few holes. We're going to get the results of the second phase in Q2, and then we're going to do a third phase of drilling, which has already started. But it's exciting. It's when you see numbers like that, and you see that you're very close to your existing infrastructure. It's an area we could access and fairly easily. But first thing we have to do before we rush into the zone with a 5 meter by 5 meter diamond drill hole, we're gonna drill, and we're gonna try not to repeat the mistakes of the past, and we're gonna drill, understand what we have, and then we're going to go in there and position ourselves properly and get going with mining. But I'm pretty confident this is going to turn out into a very good zone for us.
Okay, yeah, that's great. And maybe just continuing on that, then certainly the grades are high. What about the widths? What are your thoughts on the intercept widths? Are those also consistent with some of what you found within the reserve area of the Valley of Kings?
Yeah, well, it's fairly typical. What we emphasize is the high grade, but around these high grade zone, there's a large halo of lower grade material. Between 2 and 5 grams per ton. So when you blend everything, you can develop significant size stopes, but the first thing we have to do is do all the drilling, understand what we have, do the interpretation, and then we can start to build a corridor that we want to mine within those domains.
Okay, great. And when I look at the scope of your 2021 program, I don't see North Block listed. Like, in light of these results that you released yesterday, will you modify your 21 program to go back and do a little bit more drilling there?
No, we have, if there's a section that we show in the presentation, and you can see that we're going to have, that's all the areas that will be active in 2021 for the 195,000 meters of drilling we're going to do, and Nord Block is part of that. And so we drilled phase 1 and phase 2 in 2020, and we have started phase 3 now in Nord Block, which is higher fans and longer holes. So that's going to be done this year as part of the program with all the other zones that we're going to be drilling in 21. Okay, great. Maybe just shifting gears then to obviously your strategy this year is to increase the drilled off inventory. How do we know if you're making progress on your objective here? I mean, is it something that's just looking at maybe reduced production and grade volatility quarter over quarter? Is it going to take several quarters to really know if you're progressing? From our standpoint, I think what should we look for? Yeah, there's two aspects to this. I think the first one is to look at our drill inventory. At the end of Q3, I think we were 150 or 153,000 tons of inventory, Pat?
At the end of the year, we were at 256.
So we went from 150 to 256 at the end of the year, and we're going to continue to grow that inventory. And our objective, as Pat said, is to get to 400,000 tons by the end of Q3. As we build that inventory, I think what's going to be different for you and for you guys in particular is we're going to be able to, and we're not quite there yet, but we're going to be able, when we do these earning calls, to give you a good understanding of what's coming for the following quarter. And that's when you're going to see that we can shoot, we can predict, we can forecast what's coming for the following quarter a lot more accurately. Okay, great. And just maybe my final question, perhaps related to this, though, like as you drill off this inventory, and you've got this mill that can run above nameplate, what about making a more substantial increase to the mill throughput? What are the bottlenecks there? I think it was related something to the tailings, but if you could remind me what that is. Well, there's two major items that we need to think about. Number one, it's our permit. We're capped at 1,387,000 tons per year. So if you divide by 365, it's 3,800 tons per day. But the cap is not a daily cap, it's a yearly cap. In order to increase throughput, we would have to go for a permit amendment. And in order to do that, we want to make sure that the lake will be able to handle additional volume. So we're going to do technical studies this year. And on the flip side of that, it's to make sure the mine can supply. We have one ramp. We have a limited number of vehicles we can put in the ramp, so we need to think about all the logistics and the productivities and whatnot to see how far we can push the mine to be able to increase throughput. So those are the two major criteria: permitting and the mine capability of supplying additional tons. As Patrick mentioned, the mill is not an issue for us at this time. Okay, thanks so much for that. That's all for me. Okay, thank you, Don.
Our next question comes from John Tumazos of John Tumazos Very Independent Research. Please go ahead.
Hello. Hello, Jacques.
Good morning, John. I have a hard time to hear you, John.
Alicia, shut off the other call, please. I'm sorry, Jacques. I'm doing my best. Jacques,
Yes.
Would you buy back stock? You're doing great, and your stock is 10 times earnings. It's like Centerra in Kyrgyzstan almost.
John, that's always a good question. Our priority right now with our cash is to focus on our debt and focus on all the nice things we want to do to improve the value of the project and the drilling and whatnot. And we're not just there yet at the point where we can start to make decisions on buyback stock or dividend. This is first, it's a board decision. It's for the board to make that call, but I would say it's definitely not something for this year. It's going to be something maybe we're going to start to think in 2022.
I could ask another question, Jacques, and I might be overreacting to the phrase in the press release, improve the understanding of the ore body. But you've mined about 1 million ounces of gold and 4 or 5 million ounces of ore and some development muck very close to the ore. So you have a pretty good bulk sample by now to understand the ore body. Is it really the case that the ore body is variable? It is the way God made it. Maybe God in heaven doesn't understand the ore body well. Should you state your reserves as a range of grade rather than a single point? I think the NI 43-101 rules are sort of a fantasy, that deterministic single point numbers are often not realistic. And give your annual guidance as a grade range, and give your cash flow guidance as a grade range, and just admit that it's a hard ore body to estimate.
Well, it is of everything you said, John. Between God and the regulation, it is a hard body, a difficult ore body to estimate. And yes, we've mined quite a bit in that ore body. We have a few years of mining so far, and we're still learning about it. But we truly believe here that with the work we're going to be doing this year, and all the drilling we're going to do, and there's all kinds of other technical work that we're doing. We're not just doing drilling, looking at all the data and everything we've learned over the years. We feel strongly that when we do our 2022 update, we're going to have a much better understanding of we're going to be able to put together a much better resource reserve update than what was done in the past.
I have great confidence that you'll do as much as God could do.
Thank you, John.
Bye-bye.
Thanks, John.
Our next question is a follow-up from Anita Soni of CIBC World Markets. Please go ahead.
Hello, Anita.
Sorry, I was on mute there. Just to follow up in terms of the dilution targets that you have, could I get some color on, I know you're still targeting 12, but can you talk about how you're going to get it from the current levels back up to the 12%, or, what will change over the course of this year?
We have a lot of things that we are working on. Actually, we're working on the quality of the paste, so how we can improve the paste. You have also the fact that you can mine over your paste instead to mine under your paste fill. We have the drilling that we are working on. Actually, we have the undercut. We also what we will implement this year is we will monitor the precision of our blasting holes. So that's something that we initiate in the last days. So basically, it's all, and also we are using high technology techniques for blasting. We're using electronic detonators. No matter of that, we will review the timing. So we're working. It's where we stand actually, and it's also in direct relationship. The dilution, it will depend. The majority of our stopes or having an hanging wall, but they are 80 degrees. We have some who are maybe more at 70. So we'll investigate more on the cable bolting of the hanging wall to reduce the dilution. we have an economic rationale to do this. It's what we will assess. And basically, it's what it is. In terms of recovery, that is another aspect too. We are working hard on this. We recently purchased a block hauler with a remote jumbo to drill and blast the big piece of rock that are remaining in the stopes that we cannot extract because we have remote scoop trams to finalize the cleanup of the stopes. So the fact that we have this new equipment improve also the recovery on our side. So basically, it's not a one action. It's not a problem. It's a problematic, and it's coming with a lot of combined solution, and we are actively working on that actually. Okay. Because for us, it's a priority to improve the recovery for us and reduce the dilution is essential. Because we have, as Jean explained, we have a high-grade ore body, so we want to prone the quality before the quantity, and it's what is important in our case.
Yeah, thank you very much.
Thank you. This concludes the question and answer session. I would like to turn the call back over to Mr. Perron for any closing remarks.
Hey, thank you everyone for dialing into our earnings call this morning. We appreciate all the comments and questions and the more interesting ones. We look forward to updating you in the coming months, and I'd like to remind everyone that we're living under unprecedented times, and it's important for everyone to follow the guidelines and the restrictions and to avoid any major health issues. So once again, we would like to thank our team for their dedication and hard work as we continue to operate Brucejack. Without everyone's effort, nothing would be possible. So stay safe and have a great weekend.
This concludes today's conference call. You may disconnect your lines. Thank you for participating and have a pleasant day.